ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም። ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ትችላላችሁ።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ልምድ ባላቸው መምህራን እየተማራችሁ ጥያቄና መልስ፣ የክፍል ስራዎች፣ ፈተና መፈተን ክፍል ውስጥ እንዳላችሁት አይነት በኦንላይን ባላችሁበት ቦታ ከናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
I just want us to talk a little bit about how to determine the risk return of a portfolio or an investment, and then a portfolio, and this kind of a revision, because we had done this in corporate finance. And last week, you recall, we discussed about types of investments, the investment vehicles, the investment process, what you need to do, the steps, and we mentioned the 5 steps of investment process, and we went through them one after the other. I want us to go to practical now, the analysis, how we evaluate, the evaluation and analysis, because evaluation is basically the objective or the goal for investing is normally something that is set at a higher level or by the board. But then now, when it comes to analysis, is the finance manager who does the evaluation and the analysis, so that he reports back to the board. And this is very important because it's a very important stage, because this is where you have to give facts while you are settling on one project and not the other one. So there are those tools or models that are applied by managers or finance managers in trying to establish the most appropriate projects to undertake at any given time. So if you recall very well, among the issues that we talked about last week that are very critical for evaluating a project is understanding the market. And we have so many issues that one can talk about market, because this is where we are investing. This is where this is where we are sourcing our funds for investment. So we have to, in one way or the other, we have to interact with the market. So once we understand the market, then we shall be in good position to evaluate projects. Then secondly, we need also to understand the types of investment that we can invest in at any given time. So we have short term, we have long term fixed, we have speculative, and so on and so on. For you to come up with the proper avenue for investment, then you have to understand the market, because this is where everything takes place. In fact, if you have to invest, then you have to invest in the market. So that's why one of the areas that you're going to address is the markets, the financial markets. We have primary and secondary, and as one of you is going to address that. So it's an area that we look into. But before we go there, I just wanted us to look into the real evaluation and analysis of projects. And this is where the core is, because you come up with the right project, then you'll do a right investment. And a portfolio is a combination of projects. So it has to start with an individual project. So how do you evaluate individual projects? And then how do you combine the projects into a portfolio? So allow me to share the screen on our today's discussion. It's about risk return relationship, risk and return relationship. When we are evaluating projects, I hope you're able to see the screen, whatever we have. I'm sharing. Melat, are you there? Can you read? Melat?
Yes.
You can read whatever I'm sharing?
Yes.
Okay.
Risk
so we are talking
return relationship.
Huh?
Risk and return
Good.
relationship.
Okay. So we need to understand these variables. It's actually risk and return. They are the key variables that we evaluate for us to measure the viability of a project. We measure the viability of a project in terms of risk that the project may be possessing, and in terms of returns that the project that we expect from the project. So in a normal situation or in a normal investment environment, one would go for projects that give high returns, right? Because we always want to maximize our returns, and projects that offer or have low risks in terms of if we undertake the project. So we need to evaluate the risk vis-a-vis the returns of a project. So the cutoff line is what we are talking about, the relationship now. Where is the cutoff line? I mean, when you're looking at the risk and we're looking at the returns, so where is the cutoff, all right? The point where you have a number of projects you are evaluating, and then you come up with the projects that are reporting high returns and low risk. Those are the projects that we can go for. And risk is basically the deviations. You know, in any project, there are those expected returns, and there are those the actual returns. So the difference between expected and actual represents the risk. So for in finance, we attach some probability of realizing the expected returns that we anticipate to get from the project. So like one would say, the probability of getting 10% out of this project, returns out of this project, is probably 0.5, isn't it? All right. So we know very well probability does not go beyond 1 and does not go negative. All right. It's between 0 and 1. So we want to look into one after the other, starting with the return. So return on investment is the profit expressed as a percentage of the initial investment. So our initial investment is actually the cost that we are paying for that investment. All right. And then now, return is actually expressed in percentage. Like if you invest 100 US dollars, 100,000 US dollars, and you anticipate to get 10% of that, probably on annual basis, then it means every year you'll be making like 10% of 100,000. And that is at the return, the expected return that we expect to get from the project. Profit includes income and capital gains. So income and capital gains. So when you talk about profit, all right, capital gains is actually when we sell the initial capital. For example, if you buy a share, the capital put into the share is actually whatever money you put into the share is the capital. All right, you're putting the capital into the share, and then when you dispose of that share, you are disposing of the capital again, and also, but you make some gains. You make some gains out of that, and then profit is actually, for example, if you're in business and you're operating, you have operational expenses and you have operational revenues. So when you charge expenses against revenues, you incur, you make profits. So it can be looked from that perspective. So profit or gains are basically the same, or returns are basically the same as what you're talking about, the income as well as the capital gains. So return represents the income, which may be profit, together with the capital gains. Risk, on the other hand, refers to the variability of possible returns associated with a given investment. Possible returns, what are we expecting to get from this investment? All right, what are we expected to get from this investment? Then, what is the variations of what we are expecting to get, or what we expected to get, vis-a-vis what we actually got? Then that represents the risk. Investment risk is the idea that an investment will not perform as expected, that its actual return will deviate from the expected return. So it's actually the average accumulated, right, the average of the deviations between expected and actual returns. Risk and return of an investment is a major consideration in capital budgeting decisions. So other than those other considerations that we looked at, like capital budgeting techniques, there are also this one where we look into risk and return relationship in a project, so that we can be able to make decisions according to that. The comparison of the expected return from a given investment with the risk associated with it is the relationship between the amount of return gained on an investment and the amount of risk undertaken in that investment. So that's why we are talking about the relationship, because we tend to compare the amount or whatever the returns against the risk, all right, that you are going to incur if we are undertaking the project, so that we make informed decision. The more return sought, the more risk that must be undertaken. So there are projects which are high risk projects, and of course high risk projects have high returns. So again, the attitude of the investor matters here. So there are those investors who are risk averse, those ones who fear risk, and there are those ones who are risk takers. So in a market, you will find such kind of people or investors. So the attitude of the investor also matters a lot. If he's a risk taker, then we will go for high risk projects. But again, high-risk projects have also high returns. So that's why we have to play around with some of these variables so that we make informed decisions. Now, types of risks. A company is normally faced with two types of risks. We have the financial risk and the business risk or company risk. Now, financial risk, this results from the use of debt in the company's capital structure. So if we have too much of debt capital in our capital structure, then we are exposing the company to a financial risk. Now, financial risk is the idea that you have too much borrowing that even the lender, if he has to lend you, he will charge you high risk. Sorry, high interest. Okay, so is the risk that you may be unable to repay back the loans in case you are seeking for more loans or more credit. So this is actually what you're talking about. The financial risk is the risk of not being able to acquire more credit due to the fact that you have more credit in your capital structure than equity. Because if you have too much credit or debt capital in your capital structure, it means the company is already in the hands of creditors. The creditors are the ones who are running the company, right? And creditors have a right of claim over their money. So that's why we need to also make decisions about capital structure decisions so that we come up with a policy that controls our capital structure so that we minimize the financial risk that we may be exposed to as a company. So, so this results from the use of debt in the company's capital structure. This is due to fixed financial charges in form of interest due from the company's general gearing level. So gearing level, highly geared companies are the companies with a high level of debt capital in their capital structure. And the low geared companies are companies which have low levels of debt capital in the capital structure. Financial risk is normally measured using the financial gearing ratio, which is given as long-term debt over equity debt or equity capital, right? Long-term debt over equity capital. Now, as we continue, if you have any question, you are free to ask. Then another type of risk is business or operating or total risk. So different books will give it different names, but they all mean the same, all right? Operating or total risk or business risk. This refers to the fluctuations of the company's expected earnings due to the nature of the industry in which the company operates. So this is more specific, all right? It's more specific to the company, to the industry, all right? So that every company experiences the risk differently. But this one is further divided into two, so all right. Business risk is also known as total risk because it has a combination of both systematic risk and unsystematic risk. So a business can experience these two types of risks, systematic and unsystematic risk. So we need to understand the difference between the two. Now, systematic risk, also known as market risk or non-diversifiable risk, risk that cannot be diversified. So we have different names for the same. One could talk of systematic risk, you could talk of market risk, meaning the same thing, and undiversifiable risk, meaning the same thing. This refers to variations in returns of securities due to the factors which systematically affects all the firms adversely. Now, this is market risk. And market risk, it cuts across. The infection cuts across. It does not only affect one particular company or a sector of the economy. It affects all the companies that are operating within that economy. So this is why it's referred to as market risk, and it's not diversifiable. So we cannot do anything about market risk. It's already there. It has come. Things like war, when the country is at war, all companies, all sectors in the economy are affected. So it's different from when a company employees are having strike, are on strike. When they are on strike, that company is the only one that is affected. But when we talk of like floods, war, political war in the company, in the country, COVID-19, something that cut across all companies in the economy were affected, isn't it? So these are things we're talking about. Those are market risk, systematic risk, or risk that cannot be diversified. And we need to understand this because when we shall be evaluating portfolios or projects to form a portfolio, we are going to see how we can check for projects that can be diversified and those ones that cannot be diversified. Or I mean, those ones that if combined, risk can be diversified, and those ones that if combined, they cannot diversify the risk. Because the essence of a portfolio is that to diversify the risk, isn't it? So instead of putting all the eggs in one basket, you put them in different baskets so that if you lose one, you can save the others. You can get something from the others. These factors such as lawsuits, these factors include war, inflation. Inflation, if it's affecting the economy, all companies operating in that economy will be affected. Or securities tend to be negatively affected by factors like systematic risk cannot be eliminated by diversification. All right, so investments or projects that are affected by the market risk, they cannot be diversified generally. Okay, so later on we shall be talking about risk-free assets and risky assets. So there are those assets that are risk-free and there are those that are risky. So this is where probably this one will come out very clearly. Now, we have also unsystematic or unique or diversifiable risk that can be diversified. This refers to variations in returns of a company or a security due to factors which are unique to the specific company. Factors which are unique to the specific company. So it's actually a company that experiences it, not all companies or all sectors in the economy. So this one is more specific to the company, and that's why we are referring to as unsystematic. That means it's not affecting all other companies or all other sectors of the economy. And it can be diversified. Managers can do something about it so that they save themselves from the risk. So this refers to variations in returns of a company or a security due to factors which are unique to the specific company. These factors such as lawsuits, strikes, employees can go on strike. So the managers can say how to go about it so that they avoid that, or they save their company from such kind of situation. Successful or unsuccessful marketing programs, losing or winning a major contract. So these are things that can affect the company, and of course companies are involved in some projects. So that's why I come in handy as a manager, finance manager, so that whenever there are projects or contracts that the company is going into, then you have to evaluate them, all right, in monetary terms. What are the returns and what are the risks of going into that contract? So some contracts may backfire so that you find you're losing the whole game. And it may be a major contract to the company, so that once they lose it, it may affect them seriously or adversely. Since these events are essentially random, then the effects on a portfolio can be eliminated by diversification, where bad events in one firm can be offset by events in another firm. Okay? So that is unsystematic risk, and it's good to know that. Then we go into portfolio analysis. Is there any question, so that before we proceed to portfolio analysis, because this is where now we're going to evaluate the returns. How do you evaluate the returns of a project, and how do you evaluate the risk of a project? I think we had talked about this earlier on, or in our first class. A portfolio is a group of assets or projects or investments or securities held by an investor with the objective of maximizing returns for a given level of risk. So we want to maximize returns. Everybody goes into business so that he can maximize the returns and eventually increase his or her wealth. The main purpose of portfolio formation is to diversify risks by investing in more than one project. That's according to Markowitz. The reason why we come up with a portfolio is to diversify the risk. So it's not just about picking projects here and there to put them together so that you diversify the risk. So there is a way we come up with a good combination that will maximize our returns and minimize the risks. Normally, a combination that offers higher returns at a minimum risk is preferred. Okay? Factors that influence the efficiency of a portfolio, because how do you come up with a portfolio that's efficient, that can realize your objective of maximizing returns and minimizing risks? So one of the factors is number of securities forming a portfolio. So we cannot have endless number of securities or investments that form a good or an efficient portfolio. According to these researchers, 20 to 25 well-selected securities or investments will form an efficient portfolio. All right. At 20 assets, you approach the saturation mark. All right. So you can go up to 20, say, all right. But if you go beyond 20, then you can only go up to 25. You go beyond 25, then you'll dilute the whole investment. So if you can have a portfolio or different investments counting up to 20, then that will be a very good combination of a portfolio, which are well selected. So because this came out out of research, because we look at the various sectors that one can have in the economy, or an economy can have, if you are going to diversify according to the sectors, because there are also other factors that you have to look at. The seasonal factors, seasons, like in agriculture, if you are in agricultural sector, there are times of harvesting and there are times of planting, isn't it? You cannot harvest every time, unless you look at also the geographical factors, different locations. You are doing your agricultural activities in different locations, so that harvesting can be done at different times. So those are the various factors that you have to look at. The environment, the conditions that are prevailing within that particular area, and so many other factors. All right, labor, even the availability of labor and the skilled labor, and so many factors. So if you have to consider all these factors, then the research says that you can only come up with at most 25 well-selected projects. Otherwise, some factors may cut off other projects, and eventually you may only come up with 25 maximum. All right, so this is one of the factors that are key for an efficient portfolio. Another factor is the nature of relationship between returns of securities forming a portfolio. What is their nature of relationship? Because there are projects whose relationship is parallel. That means there's no need of having both. You can only have one, and you still find yourself achieving whatever you wanted to achieve, instead of having the two, isn't it? So if the projects that are inversely proportional in terms of returns, then, or negatively correlated in terms of returns, then those projects could make a good combination. So so as we look at this, then we need to understand, because there's a way we compute this relationship, and we can judge, we can make a decision dependent on the outcome or the output of our computation of the relationship. So there are normally two possible relationships between returns of securities forming the portfolio. One, we have positive relationship, right, and negative relationship. So we can only have one of the two. You cannot have both, all right? So for risk diversification purposes, a negative relationship is recommended, all right? Negative relationship is recommended. So we go for negative relationship. That means when one is down, the other one is up, and when the other one is up, the other one is down. So it's like that, all right? So that every time you are maximizing your returns. So we have to look at it from that point of view. Security returns are assumed to have a negative relationship if a given economic factor affects their performance in the opposite direction. All right? Their performance is affected in the opposite direction. When one is at high peak, the other one is at low peak. And when the one that is low, the time the other one is at high peak, the other one is at low peak. Then that is a very good combination, because then you are bound to maximize in all conditions. Covariance between returns of our projects. Okay, so now To measure the relationship, we are talking about relationship somewhere here. The relationship, positive or negative relationship. So we determine the relationship of between the two returns of a securities. We use covariance. And covariance between A and B can be measured by this. So covariance is actually now what we use to measure the relationship. But then we have also the correlation coefficient, which we use now to measure the association, whether negative or positive. So how do you determine covariance? Covariance of, for example, A and B, these are two different projects, project A and project B. So the covariance between the two, all right, is measured by this formula. And we are going to see how we get this. The formula is the formula and putting the formula into practice are two different things. So actually, this is what you're told. The bar RA represents the expected returns of A. The bar RB represents the expected returns of B. And then the PI is the probability of event. The probability of event. So the probability of having A and B is given as, so that is what you use as your PI. Then covariance will be negative for negative correlation association and positive for positive correlation association. All right, correlation coefficient of returns of two projects. Now, to measure the strength of the association between the returns, a standardized measure called the correlation coefficient, which is denoted by pi, it's not p, pi, is used. So read as rho or pi. So you can only have -1 up to +1, isn't it? So you cannot go beyond below -1, cannot go beyond +1. So covariance between of A and B, all right, is the standard deviation of returns of A, and then this is the standard deviation of returns of B. So when pi is equals to positive, there can be no risk reduction through a portfolio formation. We have already said that one up there. When it is 0, risk can be reduced through portfolio formation. And when it's negative, it is possible to form a duly hedged portfolio. There's a formula for this, and soon we're going to see this. So return of a portfolio, the portfolio's expected return is equal to a weighted average of the returns of the individual asset in the portfolio. The weights are the proportions of each asset in the portfolio. So it's actually the return of individual portfolio times the weight of that portfolio, of that investment in the portfolio. And then you add for the number of investments that you have in your portfolio to get the expected return of the portfolio. So this one, the important thing is how to determine this. Sometimes the formulas may be confusing or may not be followed if you don't understand the actual way to do this. Now, the bar 1, R1, R2, up to Rn is the expected return of securities. And then the weights, which is W. So actually, this is the final formula. return of a portfolio is equal to RAWA plus RBWB up to RNWN. Then portfolio risk. Risk of a portfolio is also measured by its standard deviation or by its variance. Now, standard deviation, we said that we determine the difference, the deviations of actual and the expected, and then we get the average to determine our risk. So risk in finance is basically measured by standard deviation. Correlation, covariance between the returns of two assets or securities, the risk of the constituent individual investment, all right, measured by standard deviation. So the weights or portfolio or proportions of the individual investment in the portfolio. So there are those things that one has to compute first. One is the correlation coefficient. Two, or covariance, isn't it? Two, you have to determine the risk of every individual investment. Then three, you have also to determine the weight of every individual investment in the portfolio. So these are the factors or the variables that you need to accumulate for you to determine the risk of a portfolio. Generally, for a two-set case, the following formula is used to calculate the risk of a portfolio. This one is a symbol for standard deviation. So it's given us weight of A squared, which is just covariance. And then there is the weight squared times the covariance of A plus the weight of B squared times covariance of B plus 2 times weight of A, weight of B, covariance of AB. All right. So this is the formula for determining the risk of a portfolio. And we are given what they stand for here, like risk measured by variance. For standard deviation, find the square root of that. So the square root of this will give you the standard deviation, which will represent the risk. Weight or proportion of A in the portfolio. WB is the weight or proportion of B in the portfolio. This is the standard deviation of A, standard deviation of B. So covariance between returns of A and B. That is this last initial is a covariance between A and B. Okay, so this was just a revision of what we had done in corporate finance, and portfolio is actually one aspect of investment decisions for companies, among other decisions that we made. If there are any questions, please ask before we go into the illustration. Or comments, or any clarifications?
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Any
Hello?
questions? Yeah.
No, we don't have questions.
All right. Illustration. Let's look at this illustration.
Okay.
Yeah.
Okay.
Consider the returns of two securities A and B, which depend on the states of nature with the following probabilities.
Mm-hmm.
We have returns on A and B, the probabilities and the state. We have recession, stable, and expansion. So we are required to compute the expected return of A and B, that is project A and B separately, then the standard deviation or the risk of A and B, and then the correlation coefficient of the two securities, that is A between A and B, the portfolio's expected returns, all right, of consisting 60% of A and 40% of B, and then the risk of the portfolio, So generally, these are the steps you'd go through if you are to compute the returns and risk of a portfolio. So how do you determine the risk or the return of a portfolio? We can have the figures here. So probability is 0.3, 10, 15, 10. So PI then A, then B. 10, 15, 10. Then for B, we have 5, 7.55. These are in percentages, eh? So probability 0.3, 0.4, and 0.3. 0.4, 0.3. So when you add this, you should get 1, all right? Because we cannot have a probability of more than 1, okay? Of course, these probabilities are represented by different scenarios. You have recession, whatever. And then these are the expected returns of A and B. So return of A. How do you get the return of A?
Probability time A, return A. Probability time return A.
Probability times return
Return
of A.
A.
So it is actually
0.3
0.3
times 10
times 10
plus
plus
0.4
times 15.
አባጁ ካልኩሌተር ካለሽ ጎንሽ እንግዲህ
እሺ
እስከዛ ላጻ ፕላስ 0.3
0.3
ታይም 10 አባስሽ ደምረሽ ደግሞ ነገር
times 5. So that will give us what?
no times 10 times 10
calculator.
Sorry,
times
times 10.
calculator.
yes
ስልክህን
Times 10, huh? So what does this one give you?
Sorry. 0.4 times 15 is 0.7 times 10 times 12. 12.
12.
Yes.
12%. Then return of B actually is 6. Is equals to
0.3
0.3
3 times 5
5
plus
0.4 times 7.5
0.4 times 7.5
plus 0.3 times 5 is equal to 6%.
6%.
So these are the individual
Expected.
returns of the project. All right.
Right. Okay.
So that is according to our part A of the question. Part B is the risk of each of A and B. Okay, so according to our formula for determining the risk of an individual project, is the actual return minus expected or this covariance. I'm looking for the risk.
No, go back.
How do you determine the risk? Okay, you can see here, it is the actual minus the expected. Actually, the the returns that you're given minus what you've computed, you square that and multiply by you multiply by what? The probability.
So
Okay.
10 minus 11, 12.
So
Risk of A,
risk,
expected risk of A is equal to,
first of all, we get the square, the variance. The variance is equals to
10 minus,
so 10
minus
10 minus
12
minus 12
square
times
probability 0.3.
0.3. Times 0.3. Okay, so that we have that, then plus
Plus
15
minus
15 minus
12
squared.
Times,
Are we together?
yes, times
Okay.
0.04.
Point
0.4
0.
plus
Okay, plus
10 10
10
minus 12
minus 12
square, the whole root square, and
times
probability 0.3.
0.3.
Yes, risk is standard deviation.
So that will give us what?
The risk and the cover. A risk.
What is the variance?
Standard deviation.
Yeah, let's get the variance. What's the total of this? Work out this and give me the figure. Total.
Mainly, Melat.
እየሰራው ነው እየሰራው
ከጅብ ጠበቀ ሁለት ሞባይል አለሽ
እሺ
በዛሬ ሞባይል ነው
You should be coming with the calculators, huh? These are
should be coming with calculators.
A class that requires calculators most of the time.
That is why I call to Melat. Huh?
You don't have your calculator?
I don't have it.
So you have also to remember the BODMAS rule. Eh?
Yeah.
Yes.
So you have to get the subtraction first, and if it's negative, keep it negative. Because if you square negative, it becomes positive. That's the essence of squaring all this. So you need to work with the bigger brackets first, then you add all of them together.
Okay.
What's the answer?
511.8.
500.
11.
11.8. Like this?
No. Sorry, teacher, sorry. ቆይ ይቅርታ 16.8. Yes, 16.8. 16.8.
16.8.
Yes.
So what is the square root of this?
Okay. Four point 098.
4.09.
8. Yeah.
Is that correct? Let me
I
see,
think so.
according to my workings.
Okay.
your variance will be 6. And we look for square root of 6. Huh? Can you redo your calculation?
Okay.
You know, we need to understand how to work out this. Otherwise, you miss out on this. You will not get the right answer. So 10 minus 12 is -2.
Yes. Square.
And when you square -2, what do you get? 4.
4 positive 4.
Times 0.3
I think 6.
is 1 point.
2.
1.2.
0.6 plus 1.2.
Okay.
I think it is 6. 6.
15 minus 12 is 3. When you square
Yes.
3, you get 9, right? 9 times 0.4, you get 3.6.
Yes.
2 plus 6.
Is that what you had gotten? 10 minus 12 is -2.
2.44.
You square that, you get 4
2.44.
times 0.3, you get 1.2.
Yes.
Yeah.
So when you add this, what do you get?
6
6.
1.2
plus
3.6
0.6
plus 1.2. You get 6.
6.
Oh,
Yes.
sorry.
So what is the square of 6?
2.44.
Yes, 2.44.
44. 4. Yeah.
How many 4s?
2 4s.
And the last one?
2.44. 44. Huh?
The last one is 3 decimal places.
So, okay, 3 decimal places. You can make it. No problem. 2 9. 449.
449.
Yeah.
Yeah. Always give it up to 3 decimal places.
Okay. Okay.
Yeah. The more the decimal places, the more accurate you are.
Okay.
So this is what we are having as our risk for A. So this one is wrong. Melat, this one is wrong. I don't know how you got this, but I hope you are following what we did here.
Okay.
Is that okay? Is that okay?
Yes.
So can you do for B and give me the answer? Determine the risk for B. Determine the risk for B, and then you give me the answer.
Okay, wait a minute.
Okay.
1.688.
1.688.
Yes.
1.688.
688.
Melat, are you getting the same? Melat has disappeared. Melat, what are you
Hello?
getting? What are you getting?
I didn't get it.
You didn't?
Yeah.
What was your figure?
Hello? ታሜ
What was your figure?
Right.
What figure did you get?
16.8 እኮ ነው የሚመጣው።
16 ነው የመጣው?
16.8 ነው የመጣልኝ።
አይደለም 1.688
ኧረ 1.6.8 ነው ያገኘሁት እኔ ደግሞ።
1.688
Girma, what
Yes,
was
sir.
your variance?
The standard deviation or the variance?
The variance. What was your variance? The square, the squared. What was it total?
The squared 2.85. 2.85.
2.85.
Yes.
So you found the square root of this giving you this.
Yeah.
The square root of this giving you this.
The square root of this gives 1.688.
Okay.
I don't know how did you get it, Girma?
Girma, you need to explain how you got that.
Yeah.
First of all, it is correct.
I don't know.
You want me to confirm whether it's correct? Yeah?
Huh? I think so.
It's wrong. It's wrong.
It's
I
wrong?
think it's not correct. Yeah.
It's not correct.
Mhm.
I don't know
Why
why.
not?
Yeah.
Why?
10 minus 6.
No. 5 minus 6.
Huh?
5 minus 6. -1 square 1 positive plus
5 minus 6, yes. -1.
-1
Square that.
square of
It
1.
still gives you 1.
1, yes. 7.5
Yes. And then,
minus
5 minus 7.5.
minus
No.
6.
Okay. 7.5
It's
minus
minus 6.
6.
It gives
Will give you
1.5.
1.5. You
Square of
square
it
that.
2.25
Yes.
plus 5 minus 6 again. It gives 1. Square of 1 0.3. So 0.3 plus 2.8 plus 0.3. It gives 2.85
0.3
Okay.
plus 2.25
0.3 plus
plus 2.25
2.25
plus
times
0.3.
0.4 times 0.4.
Why?
See the probability. The probability is 0.4. Why are you leaving out the probability?
Okay, I'm leaving it. Is that okay? Sorry, okay.
Okay, have you seen that?
That's yes.
Yes, you saw in the
omission
first place. In the first case, we had a 0.3 multiplied by everything here. Same to the second case. So you forgot to
2.85
include this.
10.4. Okay.
Yeah.
So it will be 0.9.
It gives you what?
0.9.
I mean, total of everything now.
Total? See? Let's see. 1.5.
Yes. So the square root of that?
Okay. 1.224.
Yes.
1.4.
So you can see you're wrong, huh?
Yes.
Yeah.
I get it.
You get it now.
Yes.
And
This is omission.
and
Data omission.
Emelet, are you following what we are doing? Emelet?
Yes, yes,
Melat?
yes, Doctor.
Yes.
Yes,
And,
Can you show Melat?
there's a
Oh.
Mebet. There's a Mebet also.
Yes,
yes,
maybe also. Yeah.
Okay. So this is what is expected of us in terms of determining the return of a single project and the risk of a single project. All right. And as I said, for you to determine for a portfolio, then it's just you start by doing this. So what is the expected return of a portfolio? That's part C. The part C of the question. All right. We need to compute the correlation coefficient to see how the two projects can combine or not. Whether they can combine or not. Huh? But if we know the risk, if we how would you determine the return, the portfolio returns? Allow me to use this section. I wanted to erase this. So return of a portfolio is equals to, what is the weight of A and B? We've been told is 60% and 40%, isn't it?
Yes.
So it is weight of A times return of A plus weight of B times return of B. So our return of portfolio return is 0.6 times times 12 plus 0.4 times 6. This 6 and this 12. So this will give us what? What's the answer?
Okay. Okay.
9.6, Doctor.
9.6%.
Yeah.
So that's the return of a portfolio of a combination of 60% of A and 40% of B. Okay. Now, any question? So we want to go to now determining the correlation coefficients. Okay, so this is supposed to be return of A minus that return of A the tan of B minus B. This is not supposed to be, it's supposed to be B times PI. So here we are not squaring. All right, we are not squaring. So what we need to do, all right, to determine the covariance, so allow me to erase this so that I hope you have all this, you have written this. So covariance AB is equals to I should not have erased the figures. It was 10 minus 12 into bracket times it was 5 minus 6 times 0.3 plus, so this is on its own, plus the other one was 15, huh? The next one, was it 15? 15
Yes.
minus 12 all right, times 7.5. All right, 7.5 minus
Minus 6.
okay, times 0.4.
Okay.
Then plus, okay, it was 10 again, 10 minus 12 times the other one was 5 again, minus 6 times 0.3. Okay, so can you work out this? So you need to work with this first. You need to work with this first. Then you get this. Then you get this before you add. Are we together?
Yes.
Yes.
So 10 minus 12 is -2 times 5 minus 6. -2 times 1 times -1 is what? Multiply by 0.3. Get the figure, write it somewhere, add. Then work out this as well. Put it there. Then work out this, put it there. So
Okay.
for this one, what do you get?
0.6.
0.6?
Yes.
Then plus,
Two.
work out this.
Okay. 4.5 times 0.4. 1.8.
1.8.
Yeah.
And work out this
0.6, 0.6.
0.6. So total
3.
3.
It's cancer, yeah.
So 3 is the covariance. So if we want to know the strength, 3 is positive, isn't it?
Yes.
It's positive because all
Yes.
these are positive, so it's positive.
Mm.
Positive. So what does this tell us? The covariance is positive. What is the meaning of this? How do you interpret this? It means we cannot diversify the risk
Yes, yes, you're right.
by
Yes.
combining the two projects, isn't it?
Yeah, right.
Yeah.
Not diversified.
We
It's
cannot
positive.
diversify the risk. For positive, no, yes. For negative, yes, isn't it? So risk can be diversified
It
by
is a
combining the two.
systematic risk, I think.
Yes, yeah. Then now the strength or the association, the association level, which is the correlation coefficient, which we said we use rho or pi, something like p, but it turns like this. This is a simple, is given as covariance A and B over standard deviation of A times standard deviation of B. I think that is the, what was the standard deviation of A? What was the standard deviation of A?
Standard deviation of
A.
A. 2.449. 449.
And of B?
B 1.224.
So this is equals to 3 divided by, you said 2 point?
2.449
times
1.2.
2. It was 2? 2. Was it just 2? Hello? Hi? It's lost. Hello? Melat?
Yes, sir.
I think Girma is lost. We've lost him.
Yes, yes.
1.2247. Actually, this is 1.4495 2247. Two, 4
4, yeah.
And this is 5. So this gives us what? Work out this.
Okay.
3 divided by that.
2.449. 5 times 1, 2, 2, 4, 7.
1.50.
Hmm?
1.50.
Oh.
1.5.
1.499.
499, yeah.
1.5.
How? How?
1.4999.
Yes, 1.4999.
2.9999.
Yeah.
Hey, how are you getting that?
2.443 over 3 divided by
Yes, you need to work out
2.449.
this part. What will
Yes?
this give you? It will give you 3 over what?
2
You know,
point
you must be
4,
careful
4.
when you are working with this. Huh?
Are we going to?
Yeah.
3 over what? Can you work out this?
Oh, yes.
What do you get when you multiply this by this?
Okay.
2.99.
2
2 point
2.99.
4 7. 2.999.
9.
999. Eh?
4 nines.
Yeah.
497.
4 nines.
4 9. Yeah.
So then when you work out this, what do you get? This over this?
Sorry. 1.4999.
No. It can't be 1.4.
Sorry. Divided by 2.99.
0. 1.00.
Yes.
1.000. Yes.
This is almost 3. So 3 over 3 is 0. It's 1. It cannot be 1.4.
So
Yes. Yes.
So 1.0. 00, I don't know. 1.00.
Yeah.
So which is
4
equals
0.
to 1,
it
Yeah.
means 1, yeah.
which is 1. So this one is positive, which means the relationship, the strength of association between the 2 projects is 1. And that means the 2 cannot be combined to form a good portfolio. This is the meaning of this.
Okay.
So yes, it cannot, the 2 cannot be combined to form a portfolio because they are far much correlated. Is what is like there's no need of having both in one. You can have one and do away with the other one. Okay, this is what it means because the association level is 1. So this is the correlation coefficient. The correlation coefficient. Correlation coefficient is 1, which is symbolized with this.
Okay.
Yeah.
Yes.
So
Okay,
that's what it means, and it's important that we understand this and we be able to interpret this. So when you are asked to, like for example here, the examiner is asking you to compute the correlation coefficient between the 2 securities, returns, and comment. Comment means now what advice are you giving? Can the 2 projects combine? If
Or
they
not.
cannot, if it's positive, it means they cannot combine. And even though they cannot combine, the association is still very strong. Positive 1 is very strong,
Okay.
isn't it?
Yeah.
Yes, positive 1 is very strong. So it means the two are so much correlated. It's good as having one and not the other, isn't it? So the two cannot diversify the portfolio. Okay. Now, lastly, we need to compute the risk of the portfolio. And the risk of the portfolio, the formula is here. Where is the formula? Risk. The formula is here. All right. It is weight of A squared, variance of A, plus weight of B, variance of B, plus 2 times, so weight of A squared, variance of A squared, oh, that's variance actually, you don't need to square that, it's already variance squared. The weight of B squared, variance of B, okay, plus 2 weight of A, weight of B, of variance AB. So let's go to, we have the figures. The formula is here. The risk of P of portfolio is equals to weight of A squared, variance of A plus weight of B, variance of B, plus 2 times weight of A weight of B, okay, times covariance of A, B. So can we substitute this? Of course, if you put 2 here, if you don't put 2, then it means you have to get the square root of all this. Okay, the square root of all that. So weight of A is 0.6, 0.6 squared.
No.
The
Times
standard deviation, what was the variance for A? The standard deviation of A?
2.4495.
Okay, times
2.4495
squared. Okay, so that is that, plus 0.4 squared times
1.2247.
1.2247 squared
plus 2 times
0.6
0.6 times
times
0.4
times
3.
times 3. Good.
Yes.
That's the covariance of A and B. So
Yeah.
can you work out this and give me the answer?
Okay.
Yeah. So work out this first, then you work out this, and then work out this, and then you add everything. you give me the answer, and then you find the square root of the total. You'll have gotten your risk of the portfolio.
The first one is 2 point.
The first one is
2 point.
when you square this 2 point.
160.
Huh?
160. Yeah.
Like that.
And plus
And this one?
0 point. 0.299.
Huh?
0.2.
0.2.
399.
399 plus. Work out this.
1.44.
1.44.
44.
404.
44.
44.
2 times. Yeah.
So when you total this, what do you get?
Then maybe.
Yes.
When you add this, what do you get?
2.16 plus 0.2399 plus 1 point.
3 point. 8399.
399.
3.8.
399.
399.
Yes.
What is the square root of this? What is the square root of that?
1.9.
1 point
9595.
95
9 5
95.
6 6. Yeah.
Okay, let's see whether you are correct.
Okay.
One point 95.
956. Yeah.
It was 3.84.
3 point.
Okay, 1.9596. Which is okay. Let me see. 1.95. This is 96.
It
Because
comes
the
after
last
that
ones,
6 yeah.
you round off, huh?
Yeah, there is 6 yeah.
And this one
Okay,
was
okay.
actually you're right. This is 4. When you round off, you get 4. So when you do like this, you get that. So this is okay.
Okay.
Okay, so this is how we determine the risk of a portfolio. Any questions?
No.
No, doctor.
Comments? I want you to give, I want you to take this so that we'll go through another illustration tomorrow, just to see how we understand this. So you can take these variables as our illustration 2. Just take this information.
Okay.
Yeah.
Okay.
So we'll just go through the same process, but this is more rigorous because we have more scenario states of economy. And of course, in this case, you'll always get 2 projects, not more than 2. But we are not saying that there must be 2. You know, they can be, we are talking of 20. So we use computers to manipulate these computations and different formulas. But for our concern, for purposes of learning, then we have to use 2 projects just for learning purposes. So they just take the proportion is 50-50, then the probabilities, then the cash flows for each. And then you will go work out on that. Tomorrow we shall revisit that and confirm the answers.
Okay.
Are you okay? Are you done?
Yes. Yeah.
So you have taken this, you have taken this, you have taken this, and you have taken this.
Mm-hmm.
So you go and follow the same steps and see what you get. So tomorrow we shall revisit that. The proportion is 50-50. The proportion is 50-50. 50 for A and 50 for B, forming a portfolio. So you are asked to advise the manager. Advise the manager on the best option as an analyst, a finance analyst. How do you advise the manager based on this information? All right. So with that, I think we'll stop there for today. Tomorrow we'll pick up from there. We go through this illustration again just to.
Yeah. Oh.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጎታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።